have something to discuss with you.
Okay.
I just finished analyze proposal for next expansion, and we believe it is the right time to open new brand around Tutumpung. And I have fully analyzed about the cost, including setup, location, and everything. The total cost is around $2 million. What do you think?
That sounds great, but currently we have so many projects to focus on and we're short of money. If we accept this project, we have to raise new funds. But based on our company situation from the last general meeting, the shareholder did not agree with us to issue new share, and if we choose that, we will have the risk to be able not to pay out the obligation on time.
Yeah, but actually I recommend you to working with the consulting firm. They specialize in brand expansion, cost control, and everything. You should talk with them first. Is that sound great?
Yes.
Okay, I will talk to them and ask them to talk with you.
Okay, that's great.
Welcome to our ABC investment firm, and we will solve the problems to your company's matter.
Okay, now I would like to explain about the equity financing. Equity financing occurs when a company raises money by selling ownership shares to external investors, such as individuals, venture capitalists, or institutions. This can involve issuing shares or attracting venture capitals or private equity. And the advantage include no repayment obligation, which have cash flow, lower financial risk since there is no debt, and access to investor appetite and network. However, there are also downsides. Founder must give up some ownership and control, and profit are shared with shareholders, and public offering some come with more regulation. So equity financing is often used by startup or early stage companies that need funding and strategic support but can take on more debt.
Now let me explain you regarding the debt financing. Debt financing is when a company raises money by borrowing from external sources and agree to repay it over time with the principal plus interest. This can be done through take the loan from bank or financial institution and issuing bonds or debentures to investor. Debt financing provides immediate funds without giving up ownership in the company. Advantages of debt financing are no ownership dilution in the company. Shareholders retain full control of the business. Additionally, it is cheaper than equity finance due to tax benefit as interest payment are tax deductible. However, debt financing also has its disadvantages such as repayment obligation that must be repaid regardless of the business performance. Interest costs can be expensive, especially if credit is high, and high level of debt increase the risk of insolvency. Lastly, covenant and restriction. The bank may impose limit on operation or future borrowing of the company. Company can consider using debt financing when cost of equity is too high and when the company has a higher credit rating, which will result in lower cost due to low financial risk.
Your company is profitable, but you're short on cash right now, as I see in your document here. Given that your shareholders do not want to issue new shares, and I suggest you use debt financing. Because you keep full ownership, lower long-term costs and tax benefits. If you bring in investors, you have to give up a share of your company, possibly forever. But with debt, you keep full control and can move forward faster. So if your business is steady and just needs extra fund or cash, debt is the smarter and more flexible choice for you. Thank you for choosing our firm.
Thank you, I have solution now.
My pleasure.